Welcome to the show, it's all pretend. The smiles, the lies, the perfect end. The world's a stage, they run the flow. You clap on cue down in the front row. A final shade. Burn bright. You're blinded now, can't see the fight. Smoke and mirrors, they lead the way.
Welcome to another episode of Breaking the System. So in today's Breaking the System episode, every system collapses the same way, slowly, and then all at once. And when it does, you don't want to be doing what is popular per se. You want what survives. So tonight we're going to be talking about the assets that outlast governments, that outlast currencies and empires. We're going to look at stocks with real weight. We're going to look at gold, silver, and of course we're going to look at the new big boy on the block, which is Bitcoin. Okay. So before we jump into it, remember this is for educational purposes only. Just because I'm showing you different stocks and different things that's available, it doesn't mean that you should invest in them. It means that you should do your research. You should educate yourself on this stuff. You should break the mold, break the system, and learn to grow generational wealth. So with that, let's break the system. Here we go. Let's swap over here real quick. So talking about stocks, some stocks rise on proverbial hype. Just because they talk about it a lot. It's on the news. It's everywhere. Others rise because the system needs them. Like if we look at the system right now, what stocks need to rise? It would be tech. Anything that has to do with AI. Okay. When the economy cracks and when inflation bites, when debt rises a choking collar, three types of companies historically have survived. So over the history of the United States and the stock market itself, what would these be? Well, the first that we're going to look at would be oil, gas, and infrastructure. So we ask ourselves why. Because societies collapse without energy, right? We all need energy. Since World War I, the oil barons have survived from the 1970s inflation crisis. Big oil doubled during that era. And in 2022, we look at energy stock, they soared again, right? So when we think of the big boys, let's look at like ExxonMobil, which is XOM, Chevron, which is CVX, and Marathon, which is MPC. If we were to look these up on the stock market, those are their initials that we would look up. So all the things that we're going to be looking at today was taken from about 4 days ago. And we're all going to look at the 6-month, the 1 year, and the 5-year high points that these particular stocks and investments have hit. So if we look at ExxonMobil per se, in the last 6 months it's up 10.5%. In the last year, though, it's down 4.5%. But if we extrapolate that out to 5 years, we're looking at 184, almost 185% profit that you could have made if you were invested in Exxon. We look at Chevron. It's not quite as good. Out of the three, it's kind of the worst of these three. And then the big boy on the block right now, of course, is Marathon. 6 month is 17%. 1 year is 21.5%, and a 5 year is a staggering 358.7%. So you could have made a lot of money on Marathon per se. Okay. The other thing that we want to look at is defensive staples. So these would be things like food, healthcare, utilities. So when we look at these, people may skip vacations, right? But not food. They're not going to skip water. And of course, they're not going to skip their meds. In the Great Depression, grocery chains did better than banks, right? Think about what was going on during the Great Depression. In 2008, healthcare barely flinched. Like what was going on in 2008? Of course, the housing crisis, right? And during COVID, these staples held the line. Well, of course, these were the only companies that per se that the government would allow to stay open and to function. If you're a little mom and pop shop, like that's not going to happen. Let's just be honest. Like during COVID, there was a lot of weird, scary governmental control stuff coming down the pipeline. But like these companies were allowed to stay open and get massive profits because of that. So the three that we're going to look at today would be Johnson & Johnson, which is J&J, Procter & Gamble, which is PG, and Coca-Cola, which is KO. So once again, if you look those up on the stock market, those are going to be your tickers that you're looking for. So Procter & Gamble being the worst, you guys can see. They've had a really hard year. They're down almost 16.5%, 16.25%. 5 year, they're only up 7%. And typically a rule is you kind of want to stay in like that 10 to 12% because you have to account to inflation over time as well. And so like if your investments, whatever you're investing in, whether if it's stocks, bonds, gold, Bitcoin, collectibles, whatever it is, right? You want to be making sure that your investment is making over that average 2 to 3% year to year. And if it's not, you might want to think about getting out of that stock or getting out of that investment per se. A big staple that Warren Buffett has a lot of would be Coca-Cola. Like he makes a ton, like hundreds of millions of dollars in dividends just off his Coca-Cola stock every year. So like if you were into dividends, you might want to go with Coca-Cola. But the big boy of these three is, of course, going to be Johnson & Johnson. Now, if you look, the 5 year, they're up 43.5%, but most of that has been made, we look at in the last year to 6 months. Well, they're up 32 and 34% in the last year. So there was a few years where Johnson & Johnson wasn't really doing much, but in the last year or so, right, that stock is up quite a bit, okay? The next thing we'll look at would be what they call hard asset companies. Well, before we look at the hard asset companies, let's take a look at just a couple different things here. So, like I said, the top one is your oil, gas, utilities. Then, of course, we have the defensive staples, like we talked about, food, healthcare, utilities, different things like that. But let's talk about the Magnificent Seven for a bit. And so the Magnificent Seven is going to be the 7 best stocks that are performing on the market. And currently that is Tesla, Facebook, Amazon, Apple, Microsoft, Nvidia, and Google, right? What do all these companies have in common? Tech, right? And we look at AI, tech has been the big push lately. And tech is crazy, where Amazon is going to make you roughly 43% profit over the last 5 years. Look at Nvidia. Nvidia is up over 1,200% in just the last 5 years, right? So, for every dollar that you could have put in, you could have made 120 off of that. Like it's crazy. Like 1,200% profit is amazing. So Nvidia's killing it. But if you're looking for a stock that is a really good staple, like it's going to stand the test of time, like, look how long Google's been around. Look how long Microsoft's been around. Look how long Apple's been around. Like, these companies aren't really going anywhere unless the market starts to bottom out, right? So these Magnificent Seven stocks are really good to look into investing. And remember, for this investment stuff, we're not looking at a 6-month turnaround. We're not looking at a 5-month turn or 5-year turnaround. We're looking at the long term. What are these investments going to be worth in, let's say, 20 years from now, 30 years from now, 50 years from now, right? And most of these Magnificent Seven stocks, although they're not real good on dividends, they have started throwing out dividends for their investors. So, and that's something that you're going to make on the back end every quarter. And that's going to lower your overall stock percentage as well. So, the next thing we want to look at is, let me click over here, ETF and mutual funds. So, whereas a stock, like if you're invested in Amazon, you're just invested in Amazon. There's nothing else that drives Amazon other than just whether Amazon is doing well or not, okay? But your ETF and mutual funds, they're like a bunch of different stocks they've got pooled together. So if one goes down, right, the idea is that the other stocks within this ETF or mutual fund pick up where that one stock downfalls. So with your regular stocks, you've got lots of, wild ups and downs, up and down. With your ETFs and mutual funds, there's a little bit of movement. For the most part, they stay pretty level, right? And most of these fall within the same percentages, as you can see. FBGRX, FXAIX, FDVV, which is a high-end dividend yield, SCHG, which is Charles Schwab, MGK, and QQQ. QQQ is tech stock. They're all roughly 5 to 6 points between each other, so between 12 and like a high 18%, right, for the last 6 months. We look at 1-year projections. They're going from a 7% all the way up to a 22% increase. And then if we look at these on a 5-year basis, they're at a 62 to 100 and almost 111% increase in yield in your investment. So these are the stocks that you would want to hold for 40 years, 50 years, right? For however long, and then you retire with these stocks under your belt, so to speak. So now if we look at like the hard asset companies, so these are the businesses tied to things that like actually exist. Okay. So these are going to be mining, metals, natural resources. So we want to look at these when currency weakens, hard assets strengthen. So we look at things like gold, copper, silver, because these aren't hype plays, these are survival plays, right? And so this is where you diversify your portfolio and not having all of your proverbial eggs in one basket, so to speak, right? You want to have a little bit of gold, a little bit of silver, a little bit of copper, right, that you're invested on the back end. So if the market does take a dump, right, not all of your money takes a dump, only a division of your money takes a dump, right? And so then your gold and silver and copper and those types of things would pick up on the back end. So if we look at those precious metals, once again, we're looking at 6 month, 1 year, and 5 year. Gold is currently up 26.22. Silver is up 57, basically 57.2. Look at a year. Gold is up 59. Silver is 71. And then they're roughly about the same at 5 year out, 134 to 134. So why? So heavy coin investing. So gold is the oldest rebellion against like a broken monetary system. So when we look at Rome, right, because we're going to throw a little bit of history in this as well. When Rome debased the denarius, gold protected the wealthy, right? When France collapsed in the 1790s because of hyperinflation, gold saved families from the proverbial starvation. When Germany printed itself into oblivion in 1923, 1 ounce of gold could buy an entire block of apartments, right? So gold is that backbone that we turn to. And so when we look at the U.S., when have we used the gold? Well, 1971 to 1980, we took the dollar off the gold standard. We actually did that in 1972, where the dollar was no longer backed by gold. Okay. And when we look at the value of the dollar today compared to the value of gold, what happened? Well, the value of the dollar has went down because of that, right? Because we're not on the gold standard anymore. But gold has exploded, roughly from $35 up to $850, right? So the gold price has exploded. So when we're looking at our precious metals, our golds and our silver, it's not really what we would consider an investment. It's more along the lines of insurance. It's an insurance policy against the politically stupid, or a monetary destruction. And we want to look at things like physical coins, bars, putting your physical gold into vaults. We're not talking about paper gold, right? Because you can invest in like gold on the stock market. So that would be a gold paper. We don't want to trust me gold, which is kind of what that is, right? We want the tangible stuff that we can hold in our hand. So if the system fails, the only thing that matters is what you can hold, right? And if we have it on our possession, then, we have a little bit of money to invest in ourselves and build back what we've lost. On the other end, let's look at silver. Silver is considered like the average person or the people's metal. We also look at it as silver as gold's angry younger brother, so to speak. Because when we look at gold, we think of gold as for kings, right? Silver is for the workers. It's cheaper, but it's also more volatile, so keep that in mind as well. But historically, silver becomes more explosive because of that. Think about how many kings there are. There's not very many, right? But how many workers are there, right? There is a lot of us little workers that can invest more in silver than the big boys can invest in gold, and that's why silver is more explosive. So, once again, we're going to throw some more history in here for you guys. From 2008 to 2011, as the world tried to patch itself, silver didn't double. It went from $9 to nearly $50, right? So that's what we call a 5 times eruption, okay? Or actually, it's just a little bit over a 5 times eruption. So why is that? Well, silver is also more industrialized. We use it in things like solar panels, electronics, medical equipment. So if the world heats up economically in those areas, which it has been recently, think of all the things that like they're always redefining medicine. They're always coming up with new medical equipment all the time. Electronics, we just talked about tech. We're going through a huge tech explosion. There's more and more companies that are building, buying, and marketing these solar panels, and they're becoming more efficient. So if the world breaks, right, silver's going to rise. Silver is where wealth is built during those times of chaos. Gold protects our wealth, but silver grows it, so to speak. Okay. Now let's talk about the new kid on the block. And that would be Bitcoin. Okay. And some people kind of think this is a dirty name. So let's look at Bitcoin. Bitcoin is the outsider. It's considered the rebel of investing. The thing the machine, so to speak, didn't want but couldn't kill. Well, at least that's what they're saying. Unless we really think about it and we go to all digital, which we could, Bitcoin could, or not Bitcoin itself, but a coin like Bitcoin could be the proverbial hidden door to this digital realm of currency, right? And we have to be very, very careful with that. So don't get me wrong here. I'm not saying that Bitcoin is the end all be all. I'm saying we have to be careful of something like Bitcoin that is monetized by the government, right? And dressed up in this really fancy dress, and it sounds good and looks good, and you've got to be very, very careful with that digital currency, because if they decide to click it off, then we're left with nothing. But until then, let's get back to Bitcoin. So this was created in 2009, right after the '08 financial crisis, and it was kind of like the message in a bottle, that banks broke the world, and so like Bitcoin was the answer to exit from that world. And really read upon what happened in '08 and a few years before that. Like the financial housing crisis of '08 was because of the banking sector. Hands down, unequivocally. Like we done some stupid things, and we gave people more power in certain positions that we should have, that led to the demise in 2008, right? And like, we could have stopped that from ever happening, by not allowing certain banks to lend out to certain people, certain companies, certain practices. There were a bunch of shady things that was done just a few years before '08 that really led to that financial crisis. And because of that, Bitcoin was made. Okay. So in 2010, Bitcoin was worth less than a penny. Think about that. That was 15 years ago. Okay. In 2024, Bitcoin was over 70,000. Okay. But now let's look at Bitcoin today. So if we look at the last 5 years, yeah, it's up 400%. But the last year, it's down 7%. And the last 6 months, it's down almost 21%. So of the stuff that we could invest in, Bitcoin is extremely volatile. I think it got up to like 125,000 at one point on the high mark, maybe just a smidge above that. And just recently it dropped down to, I think it was 81 or 80, 82, somewhere in there, thousand. So it roughly dropped 40,000. Okay. How many of us everyday blue collar workers could stand to see $40,000 of our initial investment just gone, right, overnight, basically? Not a lot. So, like I said, Bitcoin is the new guy on the block. Okay. So if you're going to invest in it, just realize that Bitcoin is extremely volatile. It is very unpredictable. And a lot of it's just going to be what does the government do with it, and what does the government not do with it. Okay. So remember, gold protects you from the government. Bitcoin can protect you from central banks, right? Because it's all digital and you own 100% of it. There's no middleman, so to speak. It is digital scarcity. There's no printing. There's no inflation. There's no chairman. There's no bailout. Countries with collapsing currencies like Turkey, Nigeria, Argentina, they have seen a huge adoption of Bitcoin, and they've been exploding into this Bitcoin market. Primarily because when your monetary system, whatever you use, whether if it's the euro or the dollar or yen or whatever it is, when that money starts dying, you as an investor run to anything that is alive. Like, so what is the new hype, so to speak? Okay. So remember, Bitcoin is very volatile, absolutely volatile. But when we also look back, so was oil. So were the oil barons in the 1900s. When we could buy into railroad stocks in the 1850s, those were extremely volatile. Basically, anything that is new on the market can be extremely volatile because it hasn't had time to be adopted more widespread. And when we look at Bitcoin globally, I don't remember the exact numbers, but I'm thinking it's like less than 10% of all investing in the entire world is Bitcoin, right? So there's not a lot of investing into this stuff when we look at everything else that you could invest in. But also keep in mind that volatility I can't talk tonight, is not considered the enemy. It's dependence. What are you depending on, or who are you depending on? And by that, I mean, if you're not investing in anything, you are dependent on the dollar. You are dependent on your hourly wage and what you make and what you bring home in a week, right? Because you have nothing else that you've invested in, okay? That's dependency. So when inflation goes up, when things and people are having a hard time and the value of the dollar goes down, you're going to have less money in your pocket because that's what you're dependent on. Where if you would diversify yourself in some of these other aspects, right, you'll have something that you can turn to, right, in those hard times. When you're making less, when you're bringing less home, you can turn to your stocks and your mutual funds and gold and silver and copper and Bitcoin, and you can turn some of that stuff into hard cash that then you can use, okay? So keep in mind that this particular episode isn't about just picking one asset, so to speak, okay? Let me click back here. It's about understanding the system and how it traps you. It traps you because how many of you out there, when you were in school, were taught this stuff? How many of you were taught how to invest in the stock market? How many of you were taught that you could invest in things like railroad companies and oil companies and electric companies, that you could invest in the same places that you get your food from, like Kraft and Nestle and Coca-Cola and Pepsi? How many of you were taught in school that you could invest in gold and silver? I don't know a lot. I don't think that we ever were. They were too busy teaching and preaching 4 years of English and 3 years of math and 4 years of science and 4 years of this. And it's a lot of stuff that as an adult, you're just not going to use. You're not going to use that stuff. But this stuff, this is important. This is how you break the proverbial system. This is how you can gain generational wealth. You can start not just a savings account, but you can start 401ks. You can start a Roth for your children at any age and put $5 in it, put $10 in it, put $1 in it. It doesn't matter. And over 40, 50, 60 years, they're going to have something that they can turn to when the dollar sucks, when the economy crashes, when we go through another recession or another depression or whatever it is, right? So here's the truth, right? Stocks can grow wealth when the system is functioning properly. As we've seen lately, look at the tech stocks. The tech is going absolutely fucking bananas lately, right? So why don't we invest in some of it? Why don't we, the blue-collar workers, take advantage of some of this stuff, right? Gold preserves wealth when the system fractures, okay? In times of volatility, in times of crisis, silver can multiply our wealth when stocks are down, when the dollar value is down. And right, Bitcoin can exodus from this system altogether entirely. Okay? So each one of these different things fights the system from a different threat point. Okay? Inflation. Maybe look at gold. Maybe look at some energy stocks. When we're going into a recession, maybe look at some defensive stocks. If there's a currency collapse, look at investing into gold. Look into getting some Bitcoin. If we're having a downside in tech or a tech disruption, go into Bitcoin. Go into some growth stocks. Go into your utilities, your food companies, right? Like, if everybody's buying Coke and Pepsi, they're drinking all this soda, why don't we invest in it and we make some money when the company makes some money, right? So you don't need to predict the future, right? And so, like, with all of these things that we can invest in, we're not trying to miss the highs and hit the lows, because there's no investor that will time the market just right on anything to buy gold when it's at its lowest, or to buy Bitcoin when it's at its lowest, and to be able to sell Nvidia when it's at its highest. Like, it just is not going to happen, okay? So we continually invest in these things. When the market's down, we invest. And when the market's high, we invest. And when the market's mediocre, we invest. And we invest, right? You invest when you're young. You invest in your kids. You invest when you're old, right? You keep investing into yourself. So when you retire, you don't have to invest anymore. You've invested all of that time into yourself, and you can live a moderate lifestyle, or maybe an above moderate lifestyle, depending on the stock choices or the investment choices that you went into, okay? So in our final closing here, remember that the system isn't built for your survival. It's built for your dependency. They want you to depend on the dollar, which is backed by the government, okay? They want you to depend on the government, hands down, 100%, right? But wealth, real wealth, is based on these things the system cannot destroy, okay? Gold, silver, Bitcoin, and having an ownership in these industries that the world can't live without. Food, tech, energy, okay? This is how you invest in the future and uncertainty. This is how you break the system before the system breaks you. And with that, good night.